Okay, everyone, thank you for your patience and welcome to Option Hotline's free trading webinar this afternoon. Today we are hearing from Keith Harwood, and he is going to be speaking with you all about trading options with a directional bias. This is actually part 2 of a 3-part webinar series that Keith is putting on for us here at Option Hotline. So we are excited to have him here this afternoon. Keith, are you with us?
Absolutely. Thank you for
Hello and welcome.
Well, it's good
it's
to
nice
have
to have you this afternoon. I know a lot of attendees have just been piling in the room, so welcome to all of you. Keith is going to go ahead and get set up to present his screen, and while he's doing that, I'm going to remind everyone that if you have questions during the presentation, please go ahead and type them in the chat box, and we'll go ahead and get those over to Keith at the end of the presentation. One other important note, please be sure to stick around right after the presentation for another website tour and a special offer coupon code that you're going to want to get. All right, Keith, so if you want to go ahead and share your screen.
Yeah, let me do the share screen button here. Let's see if I do this right. I always do it wrong, so I think I did it right.
Oh, success. You did. It looks great.
Good. It's a big win. Thank you again to everybody for taking your time to discuss options trading. I mean, this is a really incredible time to be trading, honestly. You know, I've been trading for 15 years now, and you know, outside of maybe the subprime crisis, this is kind of the most unique scenario I think I've seen. And you know, every few years you get an opportunity like this, and I think right now is a great opportunity to really dive into what everyone does well and try to figure out what you don't do well, and then fix it. So that's what we're going to try to work on today with options. Today's topic is my second part of trading options with a directional bias. For those of you that missed it, I did a part 1, as you might expect, given that this is part 2, and really focused on how delta impacts a trend trading portfolio. Today, we're really going to focus on Vega. And I think this is a good one for everybody, just understanding how Vega can impact a trend trading portfolio in either positively or negatively. So with all that in mind, we always have to start with our disclosures, just because this is what my lawyers told me I have to do. So all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Oh, mouthful. Let me give you guys all 30-ish seconds to read through the rest of this, and then we will go to the actual, the good stuff instead of just the legal stuff. That was 30 seconds plus or minus, I guess. So let's go. Me, for those of you that don't remember or haven't attended an option hotline or a specific Keith Harwood webinar before, I just want to give you guys a quick background. I don't want to waste a lot of the time on this. I want to spend most of our time on the education, but you have to understand where I came from in order to understand what I can provide. So I started as a market maker on the CBOE floor. In 2005, after graduating from Notre Dame, I joined a market making firm. I spent a year learning all of these things that I'm trying to compact into a couple of hours for everybody else here. So just understand that this is a lot of information we're compacting in here. That's part of why, if you have any questions, you should automatically email me. So after spending some years as a market maker on the CBOE floor, including time during the subprime crisis, I moved off floor and actually started trading futures options. So I went from equity market making to futures market options market making, including trading, the craziness of fixed income options in Europe and gold and silver options here in the United States. And then went and got my MBA from University of Chicago and got associated with a hedge fund where I learned a lot about technical trading. And that's what really triggered my career transition. I now knew a lot about technical trading as well as a lot about derivatives trading. Putting those two things together can create massive leverage all at one good time. And that's what we're trying to provide now to the retail and individual clientele, because frankly, I'd rather have you guys make money than these other guys that are already rich and already have millions or billions of dollars make a little bit more. So that's what we're doing today. We're talking about ways that we can do that. And that's why I started Trade Academy. That's why I joined Option Hotline a couple of years ago. That's why I'm now the, chief option strategist and president of the company. And really want to make sure that you guys can figure out how options, directional trading, and everything else work together to make money for everyone here. All right. And that's what we're doing today. And most importantly, probably, is if you have to leave early, here's my contact info. Email me. You can call me. I don't care. Most people don't want you to call them. I want you to call me. If you have a problem or you have a question, you should call me. And then again, as Natalie mentioned, webinars at optionhotline.com. That's the free giveaway. That's where you're going to get it in your email box. I don't want you to miss out on that because free stuff is always better than paying for stuff. So, before we get started on the rest of the stuff, I just want to make sure you guys understand. I use these strategies to create a portfolio that does this. So Option Trend Trader, which is a trend trading portfolio on the NASDAQ 100. And this isn't fully updated. I put it through August. I'm going to have to update it for the next slide or for the next webinar. We're up a little more than that already for the year. So you put together what the NASDAQ has done up a good chunk, and you put together what an option leveraged portfolio has done, and you can see why we use options, why we use technical signals, and why we use all of this stuff to generate our return profile and hopefully outperform the market year after year. So what we're going to discuss today. So last time, for those of you that were on for Delta, a little bit in the beginning is going to be a little bit of a rehash. Don't worry. We're going to get through it quickly. For those of you that missed the first time, I recommend you go back to optionhotline.com and watch the first video, because the first video I talked about how Delta impacts a trend following portfolio. And it's important to know how Delta can change. And a lot of that also it just kind of chimes in with some of the other portfolios and the programs that I run and why you would trade a different way at a different time. Today, we're really focusing on Vega. We're going to talk again about why I use options, a little rehash on the intro to option Greeks, just for those that are watching this for the first time. I'm going to talk Vega. That's the big point. I'm going to talk trend trading signals, and we're going to start talking about why Vega matters on trend trading signals. A lot of people put together these portfolios and these programs that basically ignore Vega. And I'm going to kind of explain how they do it and why they do it, but I'd like to explain to you guys how I do it and why I do it. And that, I think, is important for what we are doing today. Given all of that, we can then do trend trading with a focus on Vega, and we can talk about the strategies I employ, and of course, what about the other option Greeks, and the final one that we're going to do in our part 3 of this series. So we got a lot to talk about today, and I don't want to take anybody else's time other than to just get through what an option really is. Here is a perfect example of why I use options. And I always put this in every single presentation I do. The reason I do it is because I want to make sure everybody understands why options can be better than stock and why options can be worse than stock. And both times are there. I mean, there are times where options are better and there are times when options are worse. Particularly when the implied volatility of the market is high, like it was a couple months ago as we started the COVID scenario, the environment. There were times where options were significantly better and significantly worse at the same time. And now I think there are times where options are significantly better and options are significantly worse, even though implied volatility of the market is lower. And for those of you that don't know what implied volatility is, don't worry. We're going to talk about it soon. So what if I have a stock that has $100 as its current entry price point, and I think it's going to go from $100 to $120? Great. This seems like a really simple thing. I can say, okay, I have a stock that's going to go to 100 to 120. And then if it goes to 60, I don't really know what I just did. I just lost a lot of money, right? So we introduce a concept of a stop loss. Stop loss is a price point that tells me I'm wrong. So in this exercise, I'm telling you that if the stock goes below $90, I'm wrong. So if it goes below $90, I get out and I start looking at another trade idea. All right, this seems pretty fair. So I have now an entry at $100. I have an exit at $120 on the upside, or unlimited, because technically the stock could get taken over for a higher price point while I'm sleeping and I can't get out at 120 bucks. I have to get out higher. Woe is me. Or if the stock starts to go lower and gets below $90, my thesis is wrong, I'm out. The key here to me, and I think to any of you here and to anybody I ever talk to, is to always understand that when a stock's going lower and you're long, that's the thing you have to focus on most. I can teach anybody how to maximize profit, but if you don't know how to minimize risk, you're making a huge mistake. And so risk management is key. Risk management is the thing that keeps us going along here in this trading game. Risk management is your primary objective. So whether I have a $120 price target or a $170 price target, my biggest thing is to know that if a stock gets below 90 bucks, I'm out. And so that's our exercise here. Stock goes below $90, I'm out. Cool, that means that my risk tolerance is $1,000. So I'm willing to risk $1,000. If I lose $1,000, I don't trade anymore on this particular name, at least for a week. The problem I've got if I buy the stock is, what happens if this particular name happens to come out with earnings or pre-announced earnings, and they announce that they have an accounting irregularity? They're not going to drop just from $100 to $90. They might drop from 100 to 60 or 50 or 40 or 0. So my real risk whenever I buy a stock is the amount of money I put into that stock. I'd like it to be less, but I have to assume it's more. When I do an options trade, I can limit that risk on the downside and at the same time leverage my upside if the stock goes the way I want. So now, instead of buying 100 shares of stock and spending $10,000, I could buy a $100 strike price call, expiring in 1 month. Cost me $5 per contract, which is actually $500 per contract since it represents 100 shares per contract. Excuse me. And then if the stock goes to my initial target of $120, each of these calls is worth $20. Each call is now worth $20 per share, which means $2,000. Sorry, $4,000. $4,000, even better. So I have now $4,000 in my pocket for my initial $1,000 entry cost. My problem is that if the stock goes down, I can get hurt. But if the stock goes to 0, worst case scenario, I lose $1,000. If the stock goes down a little bit, I still lose $1,000. That still sucks. Pardon my pseudo French, not full French. But at the end of the day, I don't want to lose. So I need to have high confidence. So when I have a really high confidence trend trading portfolio, this can work really well for me. And in the end of the day, what we're really looking at is this window. So where's my mouse? My mouse is disappeared, but you can see, up there it is. So you can see here, between $110 and $90, I'd rather be long the stock. If I think the stock has big gap risk, and I think you probably all here are aficionados, at least a little bit of the stock market, and you know some of these names that gap a lot, the Teslas, space. I'm literally naming anything that has Elon Musk associated with it, and that's not a bad thing because he creates gap risk on his own. When you see these stocks that can go high or go low, you want to use options to hedge against the downside and leverage the upside. But I want to tell you right now that you don't just have to use those Elon Musk stocks to get leverage and defined risk, because leverage and defined risk can apply to any stock in the market, whether I'm dealing with Apple, Google, Amazon, Baidu, who cares? I think I just named a bunch of tech stocks. So let's do Morgan Stanley, JP Morgan, any stock I come up with. The reason that options work is because options price in that potential for a gap move. And sometimes they price in that potential for a gap move incorrectly. And when they price it incorrectly, we can leverage it as retail investors or institutional investors. All you got to do is identify the mispricing. This is actually where institutional investors can sometimes be at a disadvantage, because if they find a mispricing, they've got too many millions of dollars to invest to really make a dent. If I find a mispricing, I buy 4 calls or 6 out of the money options calls, or 8, or you guys buy 10 or 12 or 20. Doesn't matter. It doesn't impact the pricing. When you're trying to buy 20,000, it does. So this is where we are actually at an advantage being retail clients. So with all this in mind, let's talk about how you put an option together and how Vega impacts the trade. So first things first, how do you value an option? The most well-known option pricing model is the Black-Scholes option pricing model. It's not perfect, but it's really darn good for most retail traders. It gives you a good heads up. And most importantly, it gives you the 5 inputs that you need in order to try to price an option, no matter what model you're using. Number 1 is the underlying price. That's given by the market. I might have an opinion on where it's going, but today I know where it is. The strike price, that's given by the market and cannot be adjusted. Time to expiration, that's given by the market and cannot be adjusted. The risk-free interest rate, that's given by the market, can be adjusted by the market. And we don't care because, frankly, interest rates are 0 right now. What's the biggest thing that an option trader can have an advantage on is implied volatility. This is the future expected move in percentage terms of the asset class. If I don't think it's going to move, then the implied volatility of the market's probably too high. If I think it's going to move a lot, then the implied volatility of the market's probably too low, and that's going to drastically impact the value of an option. And that's all about what Vega does for an option. That's why we're talking about Vega today. So given this, we have our Greeks. The first one, Delta, we talked about it about 2 months ago. Sorry, it was 2 months ago. For those of you, again, that missed that one, go to optionhotline.com, click on the webinar tab. You will get your deep dive into Delta. Theta, changing the option value per day. Because an option value is basically an insurance contract in many ways, if the time passes, the value of the option decreases. Big impact. People always have to know that one. Risk-free interest rate. I touched on that already. I don't think it matters that much right now. We're in a weird world where interest rates are 0. Who cares about the risk-free interest rate, frankly? Implied volatility, that's our big one today. I always touch on the second order Greek of gamma, because gamma changes your delta relative to change in underlying price. It's one of the most important second order Greeks. And we're not going to touch on that today because I have other second order Greeks that relate to changes in Vega for changes in other Greeks. So gamma is the one that like the average volatility trader looks at. You want to be a good volatility trader, you're going to want to look at the ones we're talking about today. All right? All right. Before I go any further, I see we already have one here. If you have questions, please make sure you post them on the chat window or the Q&A window. We will happily answer them by the end of this webinar and potentially during the middle of it if it fits in with what we're doing. But I want to make sure that any questions are answered. So please chat or Q&A, throw those in there as needed. And that said, let's go to visualizing Vega. And you guys are going to think this is weird because you're going to see this particular slide 3 times today. And it's not just visualizing Vega, it's visualizing the other second order derivatives of Vega or implied volatility and understanding them. And they can all be visualized in the same chart as long as you understand what you're looking at. So we're just going to repeat these ones over and over, and I'm going to tell you why the other things matter. The impact of implied volatility changes on at the money $100 call. That is directly what Vega is, okay? So when you have a long-term or medium-term option, let's focus on the purple line here. The purple line is going to be good for us here because it's kind of a midpoint. When implied volatility goes up, the option value goes up. Pretty linear when the option is at the money. And when you deal with something where the option is out of the money, it's no longer linear. Now we're going parabolic. This is what Vega is. It's the dollar increase in the option per point increase in implied volatility. And when you're dealing with a stock that has an option that's at the money, my Vega profile is very linear and I don't care. When I'm dealing with a stock where the option's out of the money, my Vega profile changes drastically. Yeah, I'd love it if I could buy volatility at 18%, implied volatility 80%, and have it go to 32. What I hate doing is buying an out of the money option when implied volatility is at all-time highs, have the stock not move, and then the implied volatility get crushed. Because then I'm buying this call for $2.25. Implied volatility gets crushed and it's worth 60, 50, 40, 30 cents. I'm losing a lot of money. That's what it comes down to. So if I'm buying here and it goes here, I make a lot of money. If I'm buying here and going down here, I lose a lot of money. And in particular, I lose a lot more money when I'm dealing with out of the money options. This is why most of the people that you see in terms of stock services, trading services, educational services, do not deal with out of the money options, because out of the money options are hard to understand and hugely risky. I would rather explain to you guys how to use them the right way. And now I have a service that uses exclusively out of the money options as a result of that. Just to be fair, I'm not going to really press you guys on that today. I'm mostly going to focus on how to do better with what most services do. And that's to focus on those at the money or in the money options and how they can leverage their returns better. But if you want to know more about leveraging those out of the money options and finding scenarios where a stock option can go from 40 cents to $2 to $3 to $4 to who knows, you should definitely contact me. And I'm going to throw my email out there again just to make sure you guys can do that. But today we're focusing on at the money and in the money, a little lower risk, because I think it's better to start with lower risk and risk management and then come back to that high risk, high reward scenario in a couple of weeks, or whenever you guys are ready to address that. What does Vega really mean? Vega is like just absolutely directly, it's the change in option value relative to a change in option the stock's implied volatility. What implied volatility is, that's the expected future movement in the stock. It's priced in percentage terms. It's annualized. So when I see a 16% implied volatility, that means that I've got an expectation of 16% movement in that stock over the next year. And when I see 16% implied volatility for a short-term option, it's not 16% for the year anymore. Now we're going to try to figure it out down to the day. All right. So for those of you that have seen some of my other snippets here and there, we talk about how 16% implied volatility is actually 1% daily move. That's where we get the chop. Okay. So when you have an expectation of 16% move in the year, which is actually a pretty darn good return for the overall market, that means that I'm expecting every single day to have on average a 1% move. It doesn't mean we're going to get 1% every day. Some days we're going to get 0.25%, some days 0.5%, some days 5%. What I want to see happen is that on average, we move 1%. That's what implied volatility tells me. When I see an implied volatility level of 16%, it means 1% per day. I just literally take that number and divide it by 16. So if I see a 32% implied volatility, it means I expect 2% per day. And if I see 160% implied volatility, which we see in some of these crazy names, it really means that we're expecting 10% per day. Okay. So all in all, if you want to know how much your stock could move every day, take the implied volatility and divide it by 16. It's a really funky number. It's really funny to do it that way. When we're dealing with the big indices, the VIX is around 22%. And it's the implied move in the S&P 500. We're basically expecting the overall macro indices to move 1.5% per day. But if you're going to go down to a tiny name, a name that's much more volatile, something that's related to like blockchain or some crazy growth name, it could have a lot higher implied volatility and could move a lot more. Now, at that point, because you have these names that can move that much, the options get that much more expensive. So if I was going to go into a name like, JP Morgan, Standard Bank, doesn't move that much. I mean, it moves, but it doesn't move nearly as much as, say, Tesla. I'm going back to my Elon Musk stocks here. You get Tesla or space. Those things move. And because they move, the options are more expensive. Okay? That's what Vega means. If all of a sudden Elon Musk said that he's going to change his corporate philosophy in Tesla in order to drop the volatility, the stock's not going to move as much, and the options on that stock drop drastically. So they get destroyed their value, and we do not want to be long options in that sort of scenario. What I want to make sure that we all know before I do this, oops, I don't know what I pressed here. Let's go back to, there it is, mouse. All right, I think I did it. There we go. I don't have time to do the trend trading signals today. We're going to use, just explain to you guys, I use a triple moving average signal to find my technical trading entries. I want you guys to know them. That's why I'm sending you as a free giveaway my 5 indicators for trading success ebook separately. You have to watch for webinars at optionhotline.com to get that free giveaway. If you have it hit your spam folder, or if you miss it, you're going to miss out on the technical side of this, and technicals plus options are the key to make this work. So be sure to get that. Be sure to watch for it, and be sure to whitelist webinars at optionhotline.com. When I do it, this is my signal. I'm going to give it to you right now. You guys are going to come back to this particular slide over and over after you read my ebook. But the key is that I'm using, like, on average about 4 months to expiration, and I'm using like a 75 delta option. Again, you want to know more about the delta, you go back to the previous webinar. You want to know more about the timed expiration, that's this webinar. And again, you want to know about the technical signals, that's the free ebook giveaway that we've got coming to your inbox in the morning. All that said, I mean, frankly, we've got Option Trend Trader, which does it all for you. So there's all these little parts that are working together to make leverage happen. okay? So you got leverage coming from time to expiration. You got leverage coming the right way from the delta. You got leverage coming the right way from the Vega. This is what we do. This is what I do. This is what I've used my time here on the SIBO floor, followed by time managing portfolios for the NYMEX pin, followed by my time working with a commodities trading advisory. You know, Steve, I think you mentioned you wanted to talk a little bit more about, I think it's about $27,000. You could do a lot more with options. That's why Option Trend Trader's up over 150% year to date. 150% can be a life-changing number for people as long as you do the risk management correctly. Now, Steve, are you on? Because I know you had mentioned you wanted to talk a little bit here when I brought this up.
Yeah, I think Steve's having some technical issues, but I do know what he wanted to share with everyone. So why don't I go ahead and do that?
Yeah, I appreciate that, Natalie. Thank you.
Yeah, no problem. No problem. I know, Keith, you're mentioning this option.
Natalie, or are you good?
No, I'm good. I'm good here. Yeah. So Keith's talking with you all about Option Trend Trader, and he just went through his results, which are quite frankly fantastic given the market conditions, especially. We want to offer you here at Option Hotline a coupon code to try Keith's program. So for attending today's webinar, you can use this coupon code, amazing year, and type it into the checkout on the Option Hotline website and get yourself $1,000 discount on this annual subscription. Huge discount for you just for attending today's webinar. I also want to note real quickly before Keith picks up the presentation again, if you have questions about his programs, if you want a helping hand, you want a one-on-one phone call to get more details about the program and what it's all about, we can have a specialized enrollment coach give you a direct call. So if you'd like to do that, go ahead and type your name and your phone number in the chat box, and we'll have the enrollment coach from Market Education reach out to you. Otherwise, we do have their phone number listed right here if you want to call them directly. And we are going to be talking a little bit more about this at the end of the presentation as well. But just a little blip here, a little pause for a free coupon code just for being here today. Keith, go ahead and take control back, and you can move on right through the presentation. Thanks for the pause.
Absolutely. Thank you so much, Natalie. And yes, I do see a couple of people have already kind of jumped on that opportunity to, you know, talk to the enrollment coach. I think it's great. It's a great opportunity. And frankly, I am happy to talk to anybody at any time about the markets. That's why I'm doing this, right? So thank you again for those that have already typed in your name in the chat box. Others, feel free to do the same. Reminder, it's already here. So we've talked about this. We're going to come back to this. It doesn't matter. Let's talk more about the educational stuff that's going to get you guys a little more excitement. The second order Greeks associated with implied volatility are crucial. We have two of them. The one that I focused on more than anything as a market maker was Vama or Volga. I always called it Volga. Everybody else likes to call it Vama. Maybe I'm unique. Maybe I had a little more fun with it. Maybe I liked the name better on Volga. I don't know. But it's the change, that should say change in Vega, not Delta, relative to a change in implied volatility. So when implied volatility goes up, I want to know what happens to my Vega exposure, right? So when implied volatility is increasing, my Vega exposure, which is my exposure to implied volatility on top of it, can increase too. That's the parabolic nature of implied volatility. I want parabolic returns. I need to have parabolic exposure. So Volga is the key for me to get that parabolic move. That's the loopy move where I can go from $1 to $30, not, you know, $1 to $2 to $3 to $4, and it's still good, but it's not great. Veta is the change in, again, Vega, not Delta, relative to passage of time. So Vega goes lower every time we tick the clock. Why? Because every day that passes, an increase in the amount of movement we expect per day matters less. Let's look at the charts. You can see it a little better, and I can explain again. I told you I was going to show you this 3 times. This is number 2. We're going to visualize Volga using these charts. So Volga, Vama, was the change in Vega for a change in implied volatility. So the change in Vega, the amount of money I make per percent move in implied volatility, is Volga. Or is Vega is the amount of money I make per percent move in implied volatility. Now I want to see how I can increase that drastically and make a heck of a lot more money if I'm right. Right? So there's two ways to make a lot of money in options. And you either need the long. I either need to have the stock move a lot more than the market said, or I need the stock market to say, I expect this stock to move a lot more. Now, if I think that the market's going to say I expect the stock market, this particular stock to move a lot more, my play is in out of the money options. Again, we talked about the at the money and the out of the money calls. The at the money calls really don't have a lot of Volga. When implied volatility increases, no matter what the time frame is, it's pretty linear, right? You see the value of that option increasing very slowly as implied volatility increases. Now, if I think implied volatility is going to increase drastically, I'm going to make all my money on out of the money options, like what we're looking at here for a $120 call. Let's just imagine a world where implied volatility is 20%. That's this line right here. Let's see if I can put a line in here, because that's the fun part. Annotate. Here we go. Drawing a line. So let's say we expect, oops. Yeah, my mouse is disappearing on me. All right, I'm not going to draw. I'm just going to talk. The impact of implied volatility changes on out of money. $120 call. From 20% implied volatility, if I expect implied volatility to go up to 30%, so let's just say that we expect a scenario that can increase the daily average move of this stock from 1.25% to roughly 2%. You know, I want to buy further out of the money calls, and I want to buy them with more time to expiration, because that 20% number that we see here is okay. You know, we've got options expiring in 3 months worth roughly 45 cents, and options expiring in 2.5 months worth roughly 25 cents. But if they go higher, because implied volatility goes higher, I can see those call options going from being worth 40 cents to being worth $2.20. That's a huge impact on my portfolio. Reminder, I'm doing this directionally on top of everything else. So if I have a stock that I think is going to go up and have implied volatility increase, I've hit the jackpot. But I want to make sure that I key in on the right timed expiration in order to maximize my leverage. That's what I do with our home run swing portfolio. So home run swing is all about taking those out of the money options and leveraging Volga. That's what we leverage when we do home run swing. It's really all about Volga. It has nothing to do with anything else except for this second order Greek called Volga. At the same time, I want to make sure that we all understand the risk, and the risk is Veta. And it didn't show up here. I'm sorry, because I hit the button twice. All right, there we go. Jesus. I'm sorry. There we go. Visualizing Veta. Veta is the change in implied in the Vega for a change in time. And now what you're really looking at is the change in the slope on the one on the left here. So Veta changes the slope and flattens it as time passes when you're dealing with an out the money call. So what that really means is that if you think passage of time is a risk, it's less of a risk in short-dated options than it is in long-dated options. Why? Because short-dated options are really dictated by movement, not by expected movement. So actual movement is the key, not expected movement. When you're dealing with an out-of-the-money option, same kind of idea. really you get down to this almost flat line when time passes. Veta can really kill as much as theta. But I think the most important thing when you're dealing with a Vega heavy portfolio is to understand the risk of Volga more so than Veta. This leads me into this sort of natural snowball effect of what I think about when implied volatility falls, which it's doing right now. Volga has a self-fulfilling prophecy effect. When implied volatility rises, people reduce position sizing. That leads to more volatility. So high volatility increases volatility. Weird. It is what it is, though. So high volatility leads to more volatility. Got to be aware of that. When you have lowering volatility or falling volatility leads to lower volatility. Why? Because as volatility falls, people increase their liquidity they're willing to give to the market. That reduces volatility further. Frankly, Volga is kind of a crazy beast as a result of this, because as implied volatility and realized volatility rises, we have more volatility. And as implied volatility and expected volatility falls, we have less volatility. That is the craziness of the VIX. So let's just look at the VIX today. We had a major spike again at the end of October. We've had major spikes in June. We've had major spikes in March. The October one was mostly election driven. But as we have this implied volatility fall, honestly, it looks like the VIX is going to get cheap. And the VIX probably should go further down. And it could go back down to that 9, 10, 11% that it used to be, even though we know that there are certain things in this world right now, pandemic and election, everything else, that just make it harder to predict stock market movement. But that's why we trade options instead, to take that calculated risk with defined risk and with good leverage. Now, we're basically done with the presentation side of the stuff. I want to make sure that I cover all the questions, but I know that there are going to be questions afterwards, because there always are. Please ping me if you need to discuss any of the following. Rolling my options position to build cash. That's a huge thing for a trend trading portfolio. Managing my trades using those 5 key technical indicators. Again, that's the free giveaway. You're going to get it. And I want you to have follow-up questions, and I want you to contact me directly. And then there's all this whole crazy stuff with term structure, skew, open interest, unusual volume, all that other good stuff. I don't normally touch on that in the free webinars, only because it's really hard to kind of like fine-tune a presentation on any of those. Better to do it one-on-one. Email me, call me, and we can talk about it more. So we have that contact information here. Once again, Keith@optionhotline.com. There's my phone number. You've got to keep an eye out for the webinar-based email, webinars@optionhotline.com. That's going to give you the free giveaway. That's going to get you positioned on the 5 key technical indicators. That's going to generate those follow-up questions. And then after that, we're just going to talk about how can we work for you. I want you to plant the seeds to becoming a winning trader, and I want you to understand the returns that we can generate in option trend trader are very applicable to anyone. It's not easy, but given time, this is something that anybody can learn to do. Anybody. All they have to do is put in the time. And so I want to give you my time and my knowledge and my understanding of what I've done over years to make and lose money to help that process for you. And that's why we're doing that promo code. I think Natalie already put it out. It's amazing year. What I want you to do right now is go to optionhotline.com. Go to the store. And that's going to be where you're going to put in your promo code. You're going to hit Option Trend Trader right here. So you take Option Trend Trader, you click, you got an option on annual or monthly. Annual is where you're getting that discount right now. Hit Add to Cart. sorry for the slight delay here. Go to your card, of course. You type in your coupon code, amazing year. I've already got it pre-populated here. Once you apply it, you are going to get $1,000 off of something that should apply at $19.97 per year. Now, a reminder, this is a portfolio that is up over 150% on the year on a $20,000 model portfolio. 150% on $20,000 is $30,000 of profit, potential profit. We don't know what's going to be coming in the years to come, but when I start to see a $30,000 potential profit and then I throw these discounts on top of it, it seems like a slam dunk to me. You guys put your trust in me. I will provide everything I can to try to help you make money, and we'll go from there. So for now, that's what I can offer you. I'm not sure why we're giving a discount, to be honest, but at the end of the day, I think it's probably worth your while. So if there are any further questions, please throw them out there right now and we can talk about them further.
Thank you, Keith. Yeah, and thanks for putting that code up again so everyone was able to see it. If you want to actually go ahead and put the website back up,
you want the
contact,
website?
or maybe just your contact information on the website so people can write that down. There you are. Yeah. We'll just leave that up here. I know we're pushing up right against our time frame here, but you already showed how to walk everyone through using that coupon code right directly on the site. So that's fantastic. Thank you. Does anyone have any questions? We have a few minutes. Oh, actually one's coming in right now. Keith, you did touch a little bit on this during the presentation, but just with everything going on, what with COVID and the presidential election and everything like that, does that change how attendees should be, marking these trades as how you explained it today? Does that change anything for you?
Yeah, so for me, when I see a lot of fundamental inputs coming into the market, I get a little bit more leery about investing in the market. Frankly, I think I'm like everybody else in that point. I try to take a little bit of a step back and say, you know what, maybe now is the time to be a little bit more cash heavy and look to trade later. Some people will tell you that's the best trading opportunity, and I think there are times where it's the best trading opportunity, but for me, coming out of that scenario is the best trading opportunity. Now we have the inputs. Now we can be told, what are the best stocks to invest in by evaluating technical signals in the market. That's where I get my leverage. So technical signals right now, getting a lot clearer, even though fundamental signals are, sort of coming in. Now they won't come around for a long time. Now is a great time, I think, for a trend following system, given that.
Okay, great. Thanks. We're actually getting several different questions from several different people about option trend traders specifically. Yeah. Maybe can you just give a little bit of a rundown on what is included when someone subscribes to option trend trader, and just kind of give them a little bit of a...
That's a good question. I want to make sure that everybody understands. So when you subscribe to option trend trader, you get a number of different things. Number one, and this is the most important thing to me. When you sign up, you get our educational course that I've, put together and authored here. So it's a little more in depth than obviously what we're getting here because it's a subscription product, but you're going to get a really in-depth understanding of how that system works. So that's the first thing. Hopefully that gets you enough you need in order to get started in this type of system. At the same time, honestly, I can read every book I want about golf, but I'm never going to be a professional golfer without going through the process with a professional golfer and actually getting on the course. So one of the things that we do here is with Option Trend Trader, you get out on the course with me. So you get to see my entries, you see how I roll positions, you see how I generate a profit, and you see how I take my exit. So you're going to see how each step goes along the way when you go through Option Trend Trader. So you're going to get everything you can here. I mean, you're really going to get the education behind it, but you're also going to see it real time with real time text alerts. So you know exactly when I'm getting in and out. Like, we're not talking about, oh, I'll tell you in a week or two. No, I'm telling you the moment I get in, the moment I get out, all the education, everything you can. And that's what you get when you sign up for Option Trend Trader.
Great. Thank you, Keith, for answering that. I've also put on the screen the description page of Option Trend Trader. It hopefully gives people a little bit more information. And if you all want to visit this, after the webinar, please read through it. It provides more information that Keith just touched on. And like he said, reach out to him directly and he'd be happy to answer any specific questions that you have about it. We are pushing right up against this time frame, you all. If you have any other questions, go ahead and throw them in the chat box now. Otherwise, I just want to remind everybody how to contact us, contact Keith. So just a quick reminder, if you have questions about webinars, free giveaways, recorded replays, go ahead and email us at webinars@optionhotline.com. Again, that's the same email address you're going to get an email from tomorrow with your free giveaway that Keith mentioned, as well as the recording. And if you have questions specifically for Keith about his products, he's given you his email and his phone number. Go ahead and reach out to him. If you want to talk to a market education enrollment coach, please feel free to reach out to them at this email and phone number.
I'm sorry to interrupt, Natalie, but I do have one here.
No, go ahead.
I know it's from Charles P., and I know you've been on for a lot of our webinars, and so I've seen you a few times. I've seen your questions. I want to make sure yours is answered. You asked how many trades.
Absolutely.
We're talking about 10 to 15 per month for Option Trend Trader. If you're looking for any further information, I just would ask you to just email me. You got my email address here on the website, and we can talk further. So.
Great. Thank you, Keith, for addressing that as well.
Yeah.
And with that said, you all, thank you so much for taking the time this afternoon to come and listen to Keith's presentation. Keith, thank you for taking the time to put together the presentation and provide this knowledge to our listeners. I know we appreciate it, and so do they. So everyone, please go ahead and mark your inboxes for webinars at Option Hotline for future webinar invites. Check our webinar page on the Option Hotline website. And we hope to see you back here again. If you have any questions, reach out to us. Otherwise, have a great evening, everyone.
Thanks again, Natalie, for hosting. And yeah, great job, everybody. And I'm looking forward to the follow-up emails from everybody here. So thanks again.
Sounds great, Keith. Have a good night, all.